Thank you.
Sure. On the next page, if we look at the labor market, we're all dealing with this in one fashion or another. The fact of the matter is that unemployment is very low. Job openings, unfilled jobs are very high. That tends to bode well for the economy. However, it's challenging to be an employer in that environment, and and usually in a recession, it's the opposite that occurs. That job openings decline and unemployment rises. So from that standpoint, the economy looks to be in, from this metric alone, an okay position. On the next page, inflation obviously is the biggest worry of the Fed. It's obviously in all of our thoughts as we buy, fill our cars with gas or go to the grocery store. But what I think is interesting about this chart is it breaks down the potentially transitory component. The Fed for so long has said all of our inflation was transitory, and finally backtracked later last year, saying, well, maybe there's some stickiness to some of our inflation. But if what this chart looks at is, okay, well, what is the potential transitory part relative to the stickier part? So if you just focused on the stickier part, it's kind of in that 3 to 4% range, which is an inflation number that we could probably live with a little bit. Unfortunately, when you tack on those energy and new and used vehicles and food, that increases that number pretty dramatically. And again, that's what the Fed is trying to fight by raising rates.
Yep. And I was just going to add, Wendy, that we'll actually, they're going to release the April number tomorrow. So a lot of new data coming in, and hopefully we'll see. And if we hit a plateau, obviously, I think that'll be good. I think that's really one of the biggest concerns for both the equity and bond markets.
Yeah, that's a great point. So tomorrow will be an interesting day. The headline for this slide is fixed income historic returns, and unfortunately, they're historically negative. If you look at the highlighted line there, March 2022, so this is as of the end of March, the 2-year return for U.S. bonds is minus 1.8%. That is the third worst since 1926. So again, it's all relative. A bad year in stocks, you lose 50%. A bad year in bonds, you lose 2. Well, now we're closer to minus 9 or 10 in the bond market. So again, it's been just a very, very challenging environment for bonds. But if you look at the chart, also the subsequent next 2 years have looked pretty positive. So again, this chart helps put into your minds that we need to be patient. And it also shows on the right hand side as to why it's important to still invest in bonds, because bonds are still one of the best investments if we were to go into a recession. On the next page, if we look at equities, I think this is a great chart. It's a little busy, but it's a great chart because it reminds us that volatility is in the equity markets. And so the gray bars represent the annual return over the last 42 years of the S&P 500. The red dots, though, represent the inter-year decline that we've had in that 1-year period. And if you go back and average all those red dots, it's about minus 14%. And that's about where we are today. So it's pretty, it doesn't feel normal. Every time you go through markets like this, it doesn't feel like it's normal, but in actuality it is. And it's a good reminder that volatility exists, and being a long-term investor pays off, because 32 of these 42 years were positive returns, even though intra-year they were negative. And then on the next page, I think it's, again, just to look at this is a heat map. So the brighter the red, the worse the performance, the brighter the green, the better the performance. It's also a nice reminder that even though this current quarter and year-to-date period have been really poor and negative, still, even with those numbers added in, we still have really strong 3, 5, and 10-year performance. Again, I think it's Sometimes you forget that we've just been having 3 years of incredible investment performance. We get used to that. And then when we see a quarter like the first quarter of 2022, it's shocking. But it really shouldn't be that shocking because it's, again, pretty normal, and we still have really strong long-term performance. If we look on the last page before I turn it over to Stephen, the best place to be invested for the first quarter was energy, up 39%. So that's just incredible performance. Over the last 1 year period, energy is up 64%. So unless anyone has any questions, I will turn it over to Stephen.
Great. Thank you, Wendy. And I'm going to skip forward a couple of pages. Quickly, just to highlight, this is the investment policy summary for the defined benefit plan. If you recall, we did make some changes in recent quarters, and we added some of the asset classes that Wendy mentioned earlier. So looking on the left-hand side, we added low correlated hedging strategies, private equity, and diversified other real assets. So we'll talk a little bit more about that when we get to individual performance. But those have been nice additions to the portfolio and have provided some downside protection during the first quarter, where we saw, quite a bit of volatility, of course. Next couple of pages just kind of highlight, where the portfolio stands from a market value standpoint. So kind of looking at the bottom right here, as of 3/31, you can see the dollar amounts for each asset class. Directly right of that, the current allocation as a percentage. And then to the right of that, our target or long-term target allocations for each of those asset classes. Again, it be consistent with the investment policy statement and that long-term target. So you can see kind of across the board, well within line of the long-term targets. The couple of areas where we're overweight would be real estate, and that's really a driver of just really strong performance in real estate over the course of the last kind of 12 months. And then we still have a little bit of exposure in reinsurance, which for those of you that have been around, we have, again, kind of gone through the process of getting out of that strategy completely. And there's probably a couple more quarters worth of distributions until we're fully out of that. But everything, again, in line with kind of the long-term targets, plus or minus a couple of percent. And so I'm going to spend a couple minutes going through the manager scorecard here. Again, this I think is a really important piece of information for you all as committee members. This highlights any concerns or any changes that we're seeing across the investment managers that we're allocating to for the defined benefit plan. Again, kind of looking at the top there, you see the 7 key criteria we're focusing on, ranging from the organization on the far left all the way to expenses and fees there on the right. We also like to, just from a transparency standpoint, show the expense ratio or fee being paid for each of these investments. That's the third column from the right. And then we compare that to a median expense ratio of similar investments that are really kind of similar universe of those types of managers, and then a ratio of the fees that you all are paying compared to the median. And so, where possible, we want to be kind of around at least the median, or of course, ideally less expensive. And so we think that we're doing that kind of across all the managers in the plan. And so, again, green is good. Yellow indicates an existing minor concern. Red would indicate an existing major concern. So you do see it towards the bottom of the page, again, that Stone Ridge reinsurance strategy with quite a few minor concerns and major concern. That is the reinsurance strategy that we are getting out of completely. So we have kept that on the scorecard just because there is still some assets in the strategy. But again, ultimately, once that position is fully redeemed, we will remove that from the scorecard. We did have a couple of changes throughout the quarter. Starting on the far left-hand side under organization, you can see about 2/3 of the way down, IMGP, alternative strategies. This was formerly Partners Select. This is one of the newer liquid hedging strategies that we've added to the portfolio. Partner Select had been acquired by what is now IMGP, as you can see in the name. This was done about 15 months ago. It was previously a minor concern. We've upgraded that to no concern. We followed that transition. We've had conversations with the team now at IMGP and feel really comfortable with how that transition's gone, with the people that are still in place managing those assets. And from our standpoint, no concern any longer as we've monitored that transition now. Moving to the right, you can see performance. That's the third column from the right, about almost halfway down. We do have a downgrade there for performance. That is Harding Lovner. That's an emerging market strategy. So investing in countries like China, India, South American countries, Russia in this case, that has been downgraded from no concern to minor concern for performance, as the 3-year and 5-year return numbers have now disappointed a little bit and has underperformed both the benchmark and its peer group. I will spend a little bit more time as we go through the table of returns talking about why it's underperformed and why we still think that Harding Lovner is a really strong manager, particularly in the emerging market space. But just wanted to bring that to the committee's attention. And then lastly, second to the right there, expenses all the way down at the bottom. Partners Group Private Equity. This is an upgrade from minor concern to no concern. There was previously a minor concern for expenses for Partners Group Private Equity strategy. Again, this is a newer strategy in the portfolio. Those fees have actually come down over time as they've garnered assets. And now, as you can see, the expense ratio is below the median. So that has now been upgraded to no concern at this time. And then we also include commentary below and on the following page of kind of some of the previous concerns and recent changes. So just want to see if there's any questions as it relates to those any of those 3 changes.
Stephen, you probably answered my question already. Let's use a Partners Group Private Equity as an example. That's a new investment strategy. I think we added last quarter. Could you explain the last 3 columns? The expense ratio for that particular strategy seems high, 2.3, but compared to the median, 80% seems low. Could you explain the relationship between these columns?
Yeah, great question, Jackie. Yeah, so the expense ratio column is the actual fee that's being paid to Partners Group in this particular example. So yes, 2.3% is certainly what we'd consider a high fee, but this is private equity, and generally with private investments, we're paying higher fees to get access again to those types of investments, and hopefully, obviously, providing long-term returns that are above and beyond what you could get in the public markets. So that's certainly the reason for the higher fee. The median expense ratio of 2.87% is all similar private equity strategy fees. And so you can see, that Partners Group comes in about 0.5% below kind of their industry peers or competitors, if you will. So we still think that's nice to see. Of course, we're paying a higher fee, but it is about 0.5% lower than kind of the industry average. And so that's what that ratio of expense to median is. It's simply the 2.31% from Partners Group divided by the median expense ratio. So we're basically just showing that Partners Group is about 80% of the cost of the peer group. Hopefully that was helpful.
Yeah, thank you. Because these are all newly added, so I just want to make sure.
Nope, and great question, and that's certainly something that you should be looking at and concerned about and keeping top of mind. And just to kind of reiterate, everything that we look at when we look at returns is all on a net of fees basis. So that includes, of course, the fees that are being paid. So everything we show from a performance standpoint is net of those fees. Any other questions on the scorecard before we go into the table of returns?
Yes. How long will it take to vacate out of that one position that is problematic, the reinsurer? Do you have
Yeah,
any
so
projections on that?
Bob, yeah, great question. Unfortunately, we don't have a definitive answer at this time. It's kind of on a quarterly basis. We get notified by Stone Ridge, our operations team, then sends that information over to us, and we'll kind of take it quarter by quarter. But a majority of those assets have come back that were invested in the strategies. I think there's about $250,000 left. If I recall, and so again, it'll probably be over the course of the next 2 to 3 quarters would be my hope. Hopefully by the end of the calendar year, we might get might be fully redeemed there.
And Bob, just so you know the process, so every quarter they allow for liquidity. So we go in and say we want to sell it all, and then they have all their shareholders also are saying they want to redeem as well. And so then they allocate, okay, based on everybody that wants to get out, we'll let everybody get 15% of their proceeds. And so that's what we do every single quarter. So every single quarter, like clockwork, we go back and ask to get it all. And unfortunately, are only allocated a certain percentage. But we again, as Stephen said, we have most of it out, and we'll continue to try to get the rest.
Yep, great question though. And I guess if we're going to say on the bright side, at least, when we look at performance, it is actually because it is generally completely uncorrelated to the market, was actually had a positive return in the first quarter. So at least, since it is still being held, at least it did add some value while we're trying to get out.
That's exactly, I wondered what was going on and how that worked, and thank you for explaining that.
Yeah, thank you, Wendy. Yeah, so basically how that works is, it's based on flows, and if there's significant flows or requests to redeem, then they kind of have to say, all right, we're going to only allow so much to come out at a time.
Yep.
And so looking at the table of returns, kind of going through some of the underlying investment managers, as we normally do, I'm not going to kind of touch on each of these, but did want to just kind of touch on a couple of the strategies that might have had, better or worse performance than the benchmark and peer group. You can see large cap equity. We're utilizing a large cap value active manager. That's Dodge & Cox there at the top. You can see actually one of the only positive performing equity manager in the plan in the first quarter. You can see up just over 1%. So some nice performance considering how tough the overall market was from Dodge & Cox. Kind of on the flip side, kind of the high quality growth manager being allocated to Harbor Capital Appreciation, which is the third line down there. Significantly challenged by the environment, as Wendy went through some of those sectors and kind of talked about what had been doing well. The growth parts of the market certainly have seen the biggest headwinds with the rising interest rates, with inflation fears, with the economic slowdown fears. So that's certainly, hurt Harbor Capital Appreciation more so than say Dodge & Cox. For example, Harbor Capital Appreciation has significant exposure to, information technology and communication services companies, which were two of the worst performing sectors across the first quarter. But again, as we always do, if you look at the longer term numbers kind of going out, 3 and 5 years, really strong returns, averaging 20% per year over the last 5 years. So, we know that long term, they're a really strong manager, but based on the type of mandate and the type of portfolio they're managing, had some headwinds and challenges in the first quarter. Moving down to international managers, I just wanted to quickly touch on again, Thornburg International Value. That is an international value manager. And again, just wanted to point out kind of why we believe in looking at long-term returns. But Thornburg International Value, you can see in the first quarter down about 10.8%, whereas the benchmark was basically flat. So underperformed the benchmark quite significantly in the quarter. But longer term, looking at kind of those 3 and 5 year numbers, you'll see one of the best performers in this part of the market. So on the 3-year number, returning about 9.5% per year, whereas the benchmark only returned, just over 5%. So even with a really poor first quarter, Thornburger still added significant value to the plan over its inception. So again, we understand that there could be, especially during volatile markets like we saw in the first quarter, there could be a lot of discrepancy in returns, especially, of course, with the active managers or those managers that are really setting out to try to beat the benchmark. But as long as, again, those longer term numbers and the process and philosophy stays in place, we like to, again, of course, stick with those managers and focus longer term. So I think that's a good example there. And then really the last one I want to touch on the equity side is Harding Lovner Emerging Markets. You can see I mentioned that we downgraded that performance to a minor concern. Really tough quarter, down over 17.5% in the first quarter. I just want to talk a little bit about why it performed so poorly. Really the primary driver was some of the allocation from not only a country standpoint, but also the types of stocks is invested in. This particular strategy did have quite a bit of exposure to Russia and Russian equities going into 2022. And so about 5% of the underperformance was directly related to the Russian stock exposure that they had. And so what they've done, because the Russian equity markets have basically froze, or there's no liquidity, there's no way to sell those stocks, they've essentially marked those values down to zero. So they're essentially just kind of taking a complete loss on those companies from a performance standpoint. So that was certainly a big challenge for them. They also invested in a couple of companies that weren't domiciled in Russia, but generated significant portions of their revenue from Russia. And one of those is actually a subsidiary of Coca-Cola. And those two names alone also accounted for about 2% of the underperformance. And then on top of that, just some kind of exposure in China to those kind of higher growth names that I mentioned that had some challenges that hurt their performance as well. So, we think it's explainable. We think, we understand why they underperformed. And we still do believe that they are a strong manager long term, but really that this quarter and the most recent 12-month period now has really hurt some of their longer term performance. So we're not recommending a change at this time, but we did downgrade that to a minor concern, and we'll continue to monitor their performance much more closely, kind of on a going forward basis. And then want to just quickly talk about other parts of the portfolio. So fixed income, again, very diversified in terms of the fixed income exposure in the portfolio. Dodge & Cox Income is the largest holding, just over 11%. The worst performer out of the fixed income managers, down about just over 5% in the quarter. Now, what we've done is we've complemented that, which is more of a kind of traditional manager, with two opportunistic managers, both PIMCO Dynamic Bond and JP Morgan Strategic Income, which we would, again, expect to kind of be a little bit more active and to position the portfolio and make changes based on kind of the market environment. You can see both of those, while both still negative, held up well compared to the benchmark, which is down almost 6% in the quarter. So PIMCO is down just over 3%. And JP Morgan down about 0.5%. So you can see the total fixed income, when you consider all three managers, was down about 4.5%, which is much better than the benchmark being down 6%. So still negative, doesn't feel great, but these managers did protect a little bit on the downside. We also have an allocation to floating rate loans, which are below investment grade loans, but the unique aspect is that the loans are what we call floating rate, meaning as interest rates rise, so does the coupon or the yield or the payment being paid out to investors. So these generally hold up better during a rising interest rate environment, as indicated by the performance only being down just under 0.5%. And then really some of the better performers throughout the quarter were in what we'd call the alternative asset classes. So real estate, in particular, the principal U.S. property fund was up 7.5% in the quarter. So significant performance, up almost 30% in the last 12 months. So again, kind of, real estate having kind of a natural inflation protection element to it has done really well. We also saw, of course, that real estate got hit very hard in 2020, so it's bounced back really nicely. And then the two low correlated hedging strategies, you can see here IMGP, which is more liquid, and then Ironwood below that, which is more of a traditional hedging strategy. If we look all the way to the far right-hand side, far right-hand column, that is the inception. So you can see the IMGP strategy was first put into the portfolio June 1st of 2021. Is down about 3.5% since then, but much better than a lot of the parts of the equity market. And then Ironwood directly below that, since we added that at the beginning of December last year, actually slightly positive. So providing some pretty strong diversification and protection for the portfolio relative to again kind of equities and fixed income during that same time frame. And then the other real kind of strong performers so far this year, Tortoise, MLP, and Pipeline, that's midstream energy, by far the best performer. Year to date, you can see in the first quarter up over 22%. As Wendy mentioned, energy was the best sector. And so midstream energy was also a really nice performer in the quarter. Versus Capital Real Assets, this is that diversified timberland, farmland, and infrastructure fund. We added that, you can see on the far right-hand side, mid-year last year, and that's up about 8.5% since we added. So again, really strong performance and adding a lot of diversification since we added that to the portfolio middle of last year. So, we think, again, in really good position there. And then Partners Group, the private equity strategy on the far right-hand side here again, you can see since inception, since that was funded, at the end of last year, that strategy is actually up over 2% through the end of the first quarter. So we really do think, adding some of these diversifiers middle and late last year really helped protect on the downside so far in 2022. So, year to date, as Wendy mentioned, down just over 3.5%. We never like to see negative numbers, but we think the addition of some of these strategies certainly helped protect a little bit more on the downside. And so that was a lot of information. Hopefully you all found that useful, but happy to just answer any questions that any of you all might have. Okay, I guess I explained that somewhat well since I'm not getting any questions. So appreciate the questions along the way. And if there's any follow-ups, or if anybody thinks of anything afterwards, again, never hesitate to reach out.
For me, it's kind of like drinking from a fire hose, but it does help. The more I do it, the more I understand. I appreciate it. Thank you very much.
Of course, Bob. And the one thing I failed to actually mention was that, of course, with interest rates rising, being that this is a defined benefit plan, that actually isn't the worst thing, because that actually decreases future plan liability. So I'm not an expert on that, but once we get, of course, those updated numbers, and we'll let the professionals talk more about that. But that's just one thing that I did want to mention from a fixed income and interest rate standpoint.
Great.
One last thing that may be related, because we talk about the market value decreased by 1.5 million. Do we know the realized loss and versus unrealized loss from that line item? Or is this the right question?
Yeah, so there might be some realized losses because, whenever we raise the money for the distributions, we have to sell investments to do that. Whenever we do that, though, we rebalance the portfolio. So, for example, if you know, so let's say that our equity target is 5% and, you know, it's actually 6. So we would take, you know, some of those equities, you know, off the table to raise funds for the distribution. So I would say that there's probably a combination. Most likely it's unrealized because we would be selling things that had done well.
Okay, thank you.
Okay. Is there any other questions or anything that we need to review on this with either company?
I think the last thing on the agenda was just the investment policy statement, because I think at the last meeting we had gone through it, and then I don't know if Jackie, Jackie McKinnon, if you think we need some kind of motion on that, or is just having the signed version in the packet all we need to do?
Jackie, are you here?
Yeah, not a Jackie M, not a Jackie O.
Wrong Jackie.
And they wanted to see the signed version, is my understanding.
Yeah.
Can you hear me?
Yes, now.
You can hear me?
Yes.
Okay. Yes, you guys had a meeting and you wanted to be able to see it this meeting for the signatures.
Yeah. Do we need to do any more on that?
I don't believe so. I think it was just there for information.
Okay. Great. Great. I have one more question. Maybe we're moving on to board member choices. We did get a response from the attorney who had done some work, and I think that was forwarded to the city attorney, and the indication I got was that was all that needed to happen. Jackie, can you fill me in on that? Is that where we stand? We now know what work was done and that's all we needed?
I have not received anything from the city attorney. That was Vicky, correct?
Right.
I can follow up with her tomorrow on that. I thought she was going to have them contact you. They did not contact.
They did contact me. They gave me a list of the work that they had done, which I forwarded to her, and she seemed to indicate in her response that that was, well, all she needed, but I'm just not positive. I thought that might come up.
Is that something you wanted to forward on to the board members? Like that for you, if you send it to me.
Actually, I'm thinking the board should have seen that before it went to the city attorney, because I think the board needed to talk about what they wanted to do with that. So
okay.
I think maybe the board should see that information. I mean, the one thing that we talked about before, I think, was after we reviewed that information, perhaps going into executive session to see if there was anything we needed to do with that.
Okay, that's probably on me. I thought that was just coming from the attorney's office. So let me see if I can get that out to you, maybe even right now.
I think Shelley has her hand raised.
Shelley?
Thank you, Rita. I did receive something from the other attorney. I don't remember when it was. It was a couple months ago.
Right.
So it did come through the email. And Bob,
think- oh.
sorry, and Bob, you do need to ask about retirements. You skipped an agenda item too, before we go on to finish it.
Okay. Okay, it seems to me that I sent that out, but I'm gonna have to go back and look at that. I will do that. And getting back to Shelley's question, I did not hear of any retirements being set before us, but could we make sure of that?
Yeah, this is Sean Weiss.
Director, what?
I did not have any retirements to present.
Okay. Okay. Rita?
I vaguely remember seeing that information from the attorney also.
Yeah, I think something went out, but I will follow up on my end. And Jackie, would you do that also?
Yes, if you want to send that to me, or are you able to send it to the members?
I'm gonna have to look to find it, so.
Okay.
Give me a minute here and I'll see if I can find that, okay?
Or you can, like I said, if you do find it, I can send it out, whatever works for you.
Jackie, I did find an email. I did not read it, but I sent it on to you. And I believe this was the one that was forwarded to the attorney.
Okay, I will get that out tomorrow morning.
Great, thank you. If it's not, and I will go back and review it a little closer, let's get together on that, okay?
Sounds good.
Thank you. Any other items? I think we have covered all the ground that we need to cover. I thank you all for your input, and I appreciate what has been happening. We're in rather trying times, so we'll just have to weather the storms. So let's batten down the hatches and proceed, okay? Thank you much. I will entertain a motion to adjourn.
So move, Phelps.
Second, Russell.
All in favor, wave bye. Bye-bye.
Bye.
Thank you much.
Bye.
All right, thank you. Bye.
Thank
Thanks,
you very
everyone.
much. Bye-bye.
Thanks, Bob.